The information in this podcast is current on the day of recording. It is general advice only and does not take a personal situation into account. It may not be suitable for you. Participants in this podcast may also own the stocks discussed.
Hi, this is Intelligent Investor Analyst Mickey Mordek, and I'm here today talking with Andrew Saker. Andrew is the Chief Executive Officer of Omni Bridgeway, which was formerly known as IMF Bentham. Omni Bridgeway is a litigation funder that is transitioning to a funds management model, and it's a stock that the Intelligent Investor has recommended as a buy since last September, and it's one we own in our growth and income funds and one I own personally as well. So having just reported its 2021 results, we thought now would be a good time to get Andrew on and learn more about the company. Welcome, Andrew.
Thanks, Mickey. No, appreciate the opportunity to chat.
No worries. So Omni Bridgeway used to be known as IMF Bentham, and it's actually been listed for 20 odd years, which a lot of people don't know. And the business was kind of a pioneer in litigation funding here in Australia and perhaps even in the world. So I thought we could kind of just start with kind of those early days of IMF, the founders and the kind of opportunity, I guess, that they spotted early on, and maybe go into how that industry has sort of evolved and been refined over time.
Yep, sure. No, it's it's an interesting history, and in essence, it listed in 2001, but it evolved out of two businesses that were private companies, one based on the East Coast, one based on the West Coast. The East Coast business was primarily focused on high volume, small value types of claims. The one on the West Coast was focused on high value, small volume claims, and they decided to join the businesses together, become listed, and pursue opportunities as a listed company. It effectively started out of the insolvency industry, and in fact, the acronym IMF it stands for Insolvency Management Fund, and that really speaks to the genesis of the industry. So the industry evolved out of an exception to the prohibition against maintenance and champity, which was allowed for insolvency-related matters. And that was the primary focus of the business when it first started back in 2001 as a listed vehicle. It eventually evolved and challenged the existing paradigms at that stage at the law that pushed the envelopes to develop into other areas, and it expanded successfully into other forms of commercial litigation finance. The significant turning point really occurred in 2006 with the High Court decision in Foster, which effectively got rid of the whole prohibition of maintenance and champity, and opened up opportunities to invest into other broader areas of litigation. That together, coupled with quite an advanced class action regime, enabled the business to accelerate its expansion and develop into a specialised litigation funder with a significant focus on class actions here in Australia. Again, it evolved further. It realised the company was a small market in terms of litigation, and it was looking to other markets. And it first ventured out to the US in 2010, and since then has been on a pretty rapid expansion program.
And so the industry, I guess, is quite interesting in terms of how that evolution has sort of happened in each market that you've been in. Has that sort of evolved in the same way, overseas as it has here so far?
Look, it's slightly different, Mickey. It's in Australia, it was quite structured, and it revolved around that litigation that was associated with class actions. Overseas, it had to create its own niche. In 2010, there were really only two operators for litigation finance in the US of any great substance, and that was Burford Capital and ourselves. In the overseas model, we explored all different types of opportunities other than class actions, which were effectively restricted to us because of the way that part of the market evolved. But we were investing into a whole broad range of commercial litigation and arbitration. So it was quite different. And one of the key significant differences in the markets is we had a greater appeal to corporate funding overseas compared to what we had here in Australia.
One of the things that sort of struck me, I guess, when I first came to Omni Bridgeway and first started learning about your business was sort of the phenomenal track record in terms of the success rate on the actual investments and also the returns that those investments had generated. Uh, could you sort of speak about a bit about how does those the economics of the funding and how those kind of cases are sort of structured in terms of the returns to you as a funder?
Sure. Look, this is really a business I inherited. I only joined the company in 2015, and its track record and the economics were really the vision of its founders, and in particular Hugh McLernon, who has been recognised as one of those industry leaders with tremendous foresight. So it's essentially based on his thesis of how litigation finance can work and the risks and how to manage those risks. I've, as I said, been very fortunate to inherit that position, we've taken in different directions and changed the way we do business today compared to what was originally the position. But a lot
Yeah.
of this speaks to his record.
Mm.
Um, Look, the
Uh,
economics of it are reasonably straightforward in the sense that we source an opportunity, which will be a litigation investment, identify the risks, we assess what the prospects of success will be, and how we can price that risk to ensure that we get an adequate return for the risks that we're taking. And that's generally been quite a successful approach. Historically, I think our overall success rate is about 85% over the last 25 years, 20 years. So it's been a proven and well-established process.
Mm. And I guess the most common outcome is normally kind of a settlement, and then kind of some go to actual judgment, and then it's sort of a little bit more unreliable, I suppose. But the so they'd been sort of funding these cases off their balance sheet, isn't that right, Andrew, for quite a long time, and they'd been doing that pretty successfully for 15 years. So, and then I guess so you mentioned that you joined in 2015. So what was it that they kind of saw that they weren't happy with? I mean, they had a nice little business that's sort of been funding these cases for a long time. They're obviously quite successful at it. So what were they kind of looking to change? What was the and I guess what was it about your background that excited them, and what was it about IMF that sort of excited you and got you into the business?
Sure. So, look, to unpack those questions, my background is I was involved with a restructuring and turnaround practice here there in Australia called Ferrier Hodgson. I'd been a partner of the practice for about 16 years, and had been involved with a number of turnarounds and restructurings around the world. Um, and as part of that role, had significant exposure to litigation finance, both as a consumer, where we used litigation finance to prosecute claims, but also on the receiving end, where a funded claim had been made
It's not where
against.
you want to be.
Exactly. No, and I had the pleasure of being of that experience with IMF at that stage, where they'd funded matters against the insolvent estates that we were administering. So it was with that I'd crossed paths with IMF Bentham, It was clearly a model that appealed to me. Insolvency, notwithstanding its negative perception, has I think, a very similar type of undertone to litigation finance in that it serves a social purpose, and that was the appealing opportunity for me, coupled with the opportunity to do something creative outside of a restructuring practice. So that's what got me into it. In terms of the the other opportunities that existed, the business was very much focused on class actions in Australia. It represented approximately 60% of the business when I first joined. Um, I had recognised that involved a significant amount of concentration risk, and so together with the executive team and the board, we developed a business plan that was to essentially diversify risk, and that diversification involved all forms of approach in terms of sourcing, geographic footprint, size, type of case, and as you mentioned, capital source. So we'd shifted from being a balance sheet investor to effectively a funds management model in concept in 2017, and through execution over a period through to 2019, when we launched all of our 7 funds. Um, and that effectively provided us and our balance sheet, and therefore shareholders, the opportunity to invest in a more diverse range of cases, a greater number of cases where we had a smaller interest but in a greater range. And that diversification of risk enabled us to eventually, once we transition through that stage, to a more stabilized earnings stream. We've pretty much completed that process now. The 2 largest investments that we had on our balance sheet which were Wivenhoe and Westgem, are now nearing completion. They're not quite complete, and with those being finally completed, we will have more or less completed the transition to being a fund manager.
Yeah, so just to, I guess, summarize, so you've got these kind of big, lumpy class action cases. In some cases, they have very binary sort of payoffs, and so to diversify that, you've sort of gone out to geography and different capital sources and different case types. But also, I guess that's a very capital intensive business model. I guess you can't necessarily grow that quickly because you have to wait for cases to pay off, and capital could be tied up for 10 years. So I guess now you can take outside capital, and that means that you can fund more cases as well.
No, that's exactly right. As a balance sheet investor, you're effectively um, hand to mouth type of existence, where you need a matter to complete to release capital and generate a profit so that you can invest into new matters. And in doing so, that's quite limiting. In 2015, the capital markets had a view of us. We were a small company. It was hard to access sufficient capital to drive the type of growth that we needed to achieve the diversification and the benefits of diversification. The debt markets in 2015 were struggling and difficult. So our alternative was private equity. And that's where we turned to these types of fund structures. Since then, we've launched 5 of our own funds. We purchased 2 when we completed the acquisition of Omni Bridgeway in Europe, and we're in the process of marketing for our 8th fund now.
Mm.
When that closes, that'll put us close to about $3 billion in funds under management.
Yeah, okay. So I definitely want to talk about kind of the position that you guys find yourselves in today. I thought just before we could do that, you maybe just touch on the merger with Omni Bridgeway, because I thought that was quite an important one in terms of building out the expertise across the organization. You had a lot of pre-judgment expertise, and my understanding is that they have a lot of post-judgment. So,
Mhm.
and that's quite complementary. So if we could maybe just touch on that and kind of the rationale there and how that merger kind of came into play.
Sure. So the thesis of the merger was that we wanted to have exposure to Europe, and in particular to civil law jurisdictions. All of our business had been focused on common law jurisdictions like the US, Australia, UK, and Singapore, etc. So this was going to give us a broader expansion into a geographic market that we hadn't otherwise been operating. We explored a number of opportunities, and we had identified Omni Bridgeway as our preferred target, and we opened up a dialogue with them, largely because, as you mentioned, they provided us with a complementary type of business line. Our focus historically had been on prejudgment merits-based type investments, where we took on all of the merits risk up to the point of judgment. We took on no risk in relation to the enforcement or collectability of that judgment once it was obtained. So we needed a very high level of certainty before we would make that type of investment. What Omni Bridgeway provided to us was the opportunity to take investments that were from the judgment position. So we took no merits risk and only relied on recovery to generate returns through the enforcement of an existing judgment or award. The theory behind that was basically that the whole would be greater than the sum of the parts, in the sense that their business would complement ours, and together we would generate a greater level of business than either of the individual parts could generate on their own. And that fortunately has proven to be the case. And since the merger, we've generated a number of co-funded investments that both have both merits risk as well as enforcement risk. And that's enhanced the business and complemented the types of offerings that we can provide to the market.
So I guess before you could kind of only go after cases up until the judgment phase, but now you can really see those cases all the way through to the enforcement stage, and that sort of opens up a whole new number of opportunities.
Indeed, it creates opportunities that didn't exist for us before.
And I noticed as well that transaction was structured in quite a unique way in terms of the share-based payments and the number of tranches that it sort of vests over, which is a little bit complicated. Why was it structured that way?
In essence, it was to pass on the risk to the vendors to prove the business. So we were prepared to buy and pay for assets that were on the balance sheet for Omni Bridgeway, that we could touch, feel, assess, and measure. But we weren't prepared to pay, for the future, because unfortunately this business, like many businesses, is driven by the individuals, and the human capital aspect of it is quite fungible. So if they're not there, then the value of the business could be lost. So it was critical to us to tie the purchase consideration to both locking in the human capital and also for them to prove the merits of the business. As it's turned out, in the first anniversary, so we're not yet quite at the second, but at the first anniversary, they exceeded target by about 60%. And as a consequence, we're awarded the full allotment of the deferred variable consideration that you're referring to. It also enabled us to ensure that the vendors bought into the combined business. The merger was, critical to the retention of those key team members, and we've been very fortunate. We've had almost zero attrition from the team that merged with us, and I think that speaks to the quality of the people, the perception of the merged business, and we were all very pleased and with the outcomes that have been achieved to date.
So you kind of started out as a litigation funder here in Australia, and then more recently you've begun to pivot to this funds management model, where you're starting to take outside capital. You've made a merger, and more recently, I guess also the Hugh McLernon has, I think, announced his intention to retire.
Mhm.
So where does that leave you now in terms of assets under management, the countries that you're in, number of offices, and I guess your culture, and how you compare now today to the other competitors in the space globally?
Look, you're quite right. Hugh has announced his retirement, and it's a significant milestone in our business. Hugh has been a, um, a very important part of the business now for 20 odd years. He came up with the idea of how to actually um, monetize this type of business and make it something that is successful and provides that access for justice that was absent in the market to that point in time. So eventual moving on, we are going to have to compensate. And we've built up a team now, so a significant headcount growth. We've moved from when I joined there were 42 staff. We're now sitting at 185. We were operating in two countries. We're now operating in 12 countries. We had 7 offices. We're now up to 20, having just opened up in Madrid and Auckland. Um, and currently, we've got, as I said, 2.4 billion in funds under management. About 50% of that's been deployed. There's still 50% of dry powder to go on that. With the launch of Fund 8, which is expected to be completed before the end of this calendar year, we'll be up to close to about 3 billion in funds under management. That puts us in terms of size and headcount, as the largest litigation funder in the world. Our next closest competitor is Burford. I think they have about 120 people in terms of headcount, and they operate from 6 offices in 4 countries. And then it drops down quite significantly in terms of headcount and geographic footprint. Um, this is a business that we believe requires scale to succeed. That provides us with the sourcing opportunities and to generate the number of investments that we need to ensure there is diversified risk within each of the portfolios that we manage. But it also provides us with management of risk in relation to the couple of critical areas of competition and regulatory intervention that exist if you operate in any one single market. So the diversification is quite important. From a cultural perspective, look, it has evolved as every business does, and we run an organisation that now has very much a global imprint. Previously we were an Australian company that exported our business to overseas venues, but now we are very much a global business, and we have key executives based in each of our key markets, and they contribute to the culture and the goals of the business.
I guess the opportunity in front of you, as you scale, and grow those assets under management is quite interesting. I guess one of the criticisms, or one of the questions people have about a business model like yours, is that you've kind of come from a position where you've been funding cases on a small scale in countries that you know really well, and you've been able to be very picky with your cases. How do you sort of scale up that process? What can you just tell us a little bit about the process, the actual case selection process? How that's done, and how you can be confident that you can sort of scale that up and not kind of sacrifice on returns.
Sure. There's many different ways to scale the business, and I guess focusing on the one area that you've touched upon. So we go through a process where we've got about 85 investment managers. They're all qualified lawyers, 15 to 25 years post qualification experience on average. We have a boots on the ground approach, which is why we've got so many offices in so many different locations. That boots on the ground approach enables us to source opportunities at an earlier stage and get involved with them so that we can do the underwriting and due diligence process in a local environment, being able to speak to the witnesses, have a look at the evidence, and get comfortable with the risks that we're taking on. Um, we generally only fund less than 5% of the investments that we see. Last year, I think we had just over 1,700 in funding applications, and we funded something like 4.4% of those applications that had been received. We have a system and a process that's been developed over 20 odd years at the IMF Bentham side of it, and over about 35 years at the Omni Bridgeway side of it. And that process and system has identified, the issues that we need to be aware of, the red flags, the positives, the pricing that works, that doesn't work. And so we've developed that track record for being able to produce reasonably high returns on individual cases, which address with combination the diversification issues that we need to manage. um, but it is that's only one element of scaling. From other aspects of scaling, we've got 85 investment managers. They're each charged with the responsibility of trying to identify a certain uh, value of investments per annum. Where it's been very low, we've been growing that, and we're able to achieve economies of scale by increasing the investment targets for each investment manager. Um, in addition, in terms of scaling, we're looking at opportunities for monetization of investments, where we will actually acquire the underlying investment rather than just act as a commissioned agent or an agent where we receive portion of the returns. So there's plenty of ways to scale it. The fundamental issue is that litigation finance, whilst growing in awareness and acceptance, still only has about a 5% penetration rate into the total addressable market, which provides significant headroom for growth. I don't ever expect the business to grow to a stage where we have 20%, for example, of market share. That Our biggest competitor is self-funding, and I don't think we will ever be able to shift the dial to that level. But I do expect that there will be opportunities to double market penetration over time, and in doing so, grow the capacity to invest more and more capital.
Mm. Yeah, so and I guess a lot of people, because as you've scaled, you sort of built up this referral network. You've got these processes in place that is sort of time tested, and you've sort of got that expertise. So people that is it possible? Because a lot of people think, if I've got some capital and I've got some good lawyers, can I kind of enter this market and compete with you?
Mhm.
And there must be a lot of people trying to do that, I guess, if you're getting good returns. So, do you see that as a threat?
Look, there's no doubt that there's reasonably low barriers to entry to commence a litigation finance business. In fact, as you say, any two good lawyers with $100 million could open, hang a shingle out and become a litigation funding business. The proof in the industry, or what we've seen over time, is that that actually doesn't work. uh, and for the very reasons that we'd identified back in 2015. Concentration risk is the key problem with
Mm,
the business. You need scale to achieve diversification, to provide for those risks that can be mitigated against the binary outcome of a win or a loss.
mm,
And so, whilst there might be low barriers to entry, there are, in our view, very high barriers to be successful in this industry. And those very high barriers really come down to scale, track record, experience, um, what we call an extended product service, which is a combination of the provision of capital, both human and financial, to the management of risk, as well as we think a mixture of different legal aspects of risk exposures to different jurisdictions as well as different case types.
Before we kind of push on to the opportunity, which I really want to get to, or talk a little bit more detail about that. Another snag, I guess, you've got kind of two that pretty common, concerns about the business is some people think that litigation funding isn't necessarily it takes up court time and it's expensive for businesses to deal with it, and there's also increasing kind of regulation in the industry. How do you guys think about that? And do you see it as having, what's your view on those issues?
Well, from a perception that of whether or not litigation funding is good for society, the fundamental issue is that litigation is expensive, and even the most solvent corporates would agree that funding litigation expenses is a drag on your P&L, a drag on your return to shareholders. It sucks up management time, and as a consequence, it's an enormous cost, and often for them produces little movement in terms of their asset position or their return on equity. So litigation finance provides a solution for both solvent and the impecunious to offlay the risk of litigation. It provides the impecunious with the opportunity to fund litigation against deep-pocketed defendants who would otherwise outspend them and deny them the opportunity to have access to justice. So I think, notwithstanding the very vocal and vitriolic opposition to litigation finance, there is a fundamental acceptance that litigation, even by our opponents, that litigation finance provides a benefit to society. And the recent regulatory reform movement, um, particularly here in Australia, that has been focused on litigation finance, has on every occasion acknowledged the benefits of litigation finance. So I think that is beyond dispute. In terms of the regulation aspects, we're a big supporter of regulation and have been for many years since our inception. Regulation, from our perspective, legitimizes the industry. Without regulation, you've got a series of participants that can act as cowboys. You end up with outcomes that are not consistent with the goals and the aspirations of true industry participants like ourselves. And so regulation, I think, is an important evolution. What has been developed here in Australia to date has been a positive. To have licensing for litigation funders is to require them to prove that they're financially capable of completing their obligations. To have those administered as MISs is a little more controversial. It's a cumbersome procedure, and I don't think ideally suited for litigation finance. And we've seen a recent decision handed down by Justice Beach, where he identified exactly those issues of the difficulties that exist within the MIS regime as they apply to class actions. But overall, regulation is a positive for the industry, and it's been a positive for our business since licensing has been introduced. In the 3 years prior to licensing, we had launched 2 class actions. In the 1 year since licensing had been introduced, we've launched 6 class actions, and we have 7 in the pipeline. So for us, it's been a positive development.
And I guess, as you said earlier, the risk of adverse regulation in any one jurisdiction as you expand into all these other markets as well is hopefully being diversified away a little bit as well.
Indeed, indeed.
So I guess so for you as well now. So you've gone from 0 to 2.5 roughly in funds under management
Hmm.
in a few years, and you're hoping that'll be closer to 3 by the end of this year. You're
Hmm.
aiming for 5 by 2025.
Hmm.
Um, so what's what I guess is the demand like, from an investor's perspective in this asset class, from where I'm sitting, you're looking at pretty great returns, the non-correlated with the general market. Are you seeing what's investor appetite like for your products at the moment? Do you see like any challenges on the horizon in terms of raising capital? And do you see that 5 billion as a natural kind of upper limit, or is that just kind of a milestone? Do you
Yeah.
think?
So look, our three sources of capital are, the same as everyone else. We have public equity, private equity, and debt, and we access all of those opportunities. Of course, we've got internally generated profits which get reinvested, but those are our three primary sources: the public equity, private equity, and debt. And in each of those, we've seen significant appetite. And as you say, for the reasons that are, there's reasonably attractive returns. It's an uncorrelated asset class. It's an alternative, so it's got a lot of tick the box type of opportunities. I think one thing that is often underestimated or understated is the ESG aspects to litigation finance. In its purest form, litigation finance provides an opportunity for investors, both at the private equity and public equity side, to participate in an investment class that is absolutely attuned to access to justice. So, from that perspective, it satisfies those needs. So we're not seeing any deterioration in appetite for our products, and our stakeholders in the private equity side, public equity side, and debt are all very keen to continue or to escalate their investments. In terms of the 5 billion, look, that's we have, rightly or wrongly, developed a process where we have 5-year business plans, and that largely is to be consistent with the type of investment duration that we have for our underlying investments. It's very hard to turn the ship of our company, because our investments generally last, on average, 3 years for pre-judgment investments and 4 years for post-judgment investments. And therefore, we set 5-year business plans. And our second 5-year business plan, which took us from FY21 through to FY25, is to increase our funds under management from 2.5 to 5 billion. I don't think it's a ceiling. I think it's the next reset point. And we'll reassess what the next stage of growth will be from there, in 2024, when we start work on our third 5-year business plan.
And so, in terms of industry consolidation and things like that as well, I guess you've had the merger with Omni Bridgeway, and you've spoken a little bit about the need for scale, diversification, access to those kind of referral networks. What do you see from here in terms of the industry, I guess, landscape?
There's no doubt there will be opportunities for M&A in the future, whether it's through horizontal or vertical integrations. Will be interesting to see how that evolves. Whether there are going to be consolidation of litigation funders, and an acquisition of peers will be interesting. I don't think it's likely in any material way. There may be some peripherals. There's a growing secondary market which may in fact address some of those types of issues. In terms of of verticals, I suspect there will be opportunities to look at how you can build your service line, and in doing so, expand your product offering. The key, we call ourselves litigation finance, and we invest in pre-judgment and post-judgment and such, but the fundamental issue is that we are managers of legal risk. And in doing so, and we provide human and financial capital for the management of legal risk. And legal risk is such a broad uh, descriptor that it encapsulates a whole range of opportunities that could present themselves to us. And in doing so, I think that will create M&A opportunities in the future, probably more so than peer-to-peer type of mergers and acquisitions.
Mm, mm. So yeah, so you've kind of got this, healthy underlying demand now for the underlying assets, and you're kind of moving more into international markets. There's some opportunities potentially on the horizon, maybe for some M&A at some point. What about the near-term outlook? I guess you touched on kind of Ivanhoe and Westgem, and I guess there was a couple of maybe not preferable outcomes from your perspective. And there's sort of been a couple of years now where it's been a bit of a lack of profitability, at least from an accounting point of view. Should investors be worried about that? How do you think about that? I noticed as well that you've started to break out the net cash generation, which isn't exactly an accounting term, but um, how do you kind of think about that at the moment?
There's no doubt our business is complicated to understand from an IFRS accounting perspective, and that's largely because of the way we are required to consolidate funds into the balance sheet and to account for external interests as NCIs, as non-controlling interests. And that's then further complicated by the different waterfalls that exist for each of our funds. Some which are European fund models, some of them are American waterfall type models, which differentiate on the way that the cash is returned to our balance sheet and to our shareholders. Because of all that noise associated with those issues, we've been steering for the last couple of years investors towards looking at the business from a pure cash perspective. And how much cash does the business generate, and how much is it capable of of generating in the future? Um, and to effectively park the IFRS analysis and just focus on those. So, look, we do report both IFRS, obviously, we're required to, and we report very much on a cost basis. And because of that, we have a harsh accounting outcome where we have an adverse outcome, as you mentioned in say, Westgem, where we've had to make a full provision for it. Ivanhoe, is a little bit different. We invested $30 million in that, and will effectively make $120 million out of it. So it's not been a bad investment from a MOIC perspective. From an IRR, I think it sits at about 20%, which is still a good outcome, but very low by our standards. And that's because it's an investment that commenced in 2014, and we won't see the cash until the end of 2022. So from a pure accounting perspective, you get a lot of noise. So hence the reason we've been guiding people towards cash. We've got these terms of art that we've developed called EPV and our long-term conversion rate, which as a function of each other generate what we call an implied embedded value. And that's to try to bridge the difference between us as a caustic, effectively a cost reporting company, to some of our peers, such as Burford, who report on a fair value basis and actually bake into their balance sheet and P&L these fair value adjustments, which we don't do. But we need to be able to show the public capital markets, a point-to-point comparison, or at least a proxy for that point-to-point comparison, so that we can adequately compete for capital.
Mm. Yeah, so I guess the big difference is, for example, Burford will, because I guess when you fund a case, they have these kind of positive expected outcomes, and so, but you record them at cost, whereas I guess the other accounting treatment is that you can take fair value gains on those assets and book profits along the way. And I guess your accounting treatment would be more conservative because you don't book those profits along the
Oh,
way, even if,
absolutely.
yeah.
Mickey, it would make our lives a lot easier to be able to do fair value accounting, because you could, you quite frankly can report profits even though they aren't realised, and
Mm.
that might have been an astute decision by Burford to move down that path. It's not a direction we wish to go. Because I think holding a conservative position is a necessary part of you know our explanation to shareholders about how we conduct ourselves. Um, Being transparent, hiding in the open, being fully disclosive, if not somewhat of an over disclosure, is how we prefer to see ourselves.
Great. And so you've got a lot of cases coming to completion. I guess a bit of a backlog because of COVID in the US in particular, but you've got, judging by your most recent report, you've got a lot of cases coming over the next 1 to 2 years. So, I mean, that looks promising. What are the key metrics, investors should keep an eye out from here to just make sure the business is moving in the right direction? And what are you really focused on, I guess, moving forward?
Look, we're focused on completions because that's where the cash gets generated. And as you say, I think the majority of completions are going to be occurring in 2023. 2022 is going to be reasonably light compared to 2023, which is when the bulk of that backlog in COVID cases will come through. Particularly in respect of our first fund, after the capital has been repaid to their investors, which occurs this year. Next year is when the balance sheet, gets to see the bulk of the profits and the return to capital. Um, so, definitely the conversion of completions is one of the metrics. The growth in annual commitments is another key metric that investors should keep an eye on, because that's the investment in future income. And if we're not making investments into commitments into new cases, then at some point in the next 2 to 3 years, there's going to be a hole in the cash flows. So that's why a continued growth in annual commitments is important. A continued growth in some of those metrics that, as I said, are terms of art for our business, the EPV and the implied embedded value, are again key metrics that we encourage investors to focus on.
Great. Well, yeah, I think that's been great today, Andrew. It is kind of a little bit easy to get, lost in the weeds when you first come to your business, but I think we've hopefully done a decent job of making it a little bit simpler. But so yeah, looking forward to kind of watching how you guys go over the next few years, and yeah, thank you for your time today.
Thanks, Mickey. Appreciate the opportunity.